Welcome back to the channel. If you're returning, you know the drill. If you're new, my name is James, and this is your James a G, where we analyze macro market stress, physical versus paper divergence, and the institutional flows that actually move metal. I am not a financial advisor. I do not sell courses, signals, or private group access. I do not manage money, and I will never ask you for payment in the comments, via email, or direct message. This channel is educational commentary only. You are responsible for your own decisions and your own due diligence. Now, with that out of the way, let's talk about why you're here. The silver market just experienced its most violent dislocation in 44 years. From an intraday peak of $121 per ounce on January 29th, silver collapsed to below $79 by January 30th, a destruction of over 34% in under 48 hours. Gold suffered its worst single-day drop since 1980. The CME raised margins twice in 3 days. The dollar surged. Leverage positions vaporized. And yet, while Western paper markets were burning, something unprecedented was happening in Shanghai. Silver was trading at a premium so massive it defies historical comparison. While COMEX futures were limit down, physical buyers in Asia were paying prices that suggested silver was worth 30 to 40% more than the screen price in New York. This is not a normal correction. This is a divorce. Before we dissect the anatomy of this crash, the Fed chair nomination that triggered it, the margin cascade that amplified it, and the emergency critical minerals ministerial happening in Washington as we speak, I need you to do something for the community. Drop OG in the comments if you've been stacking through the volatility. I want to see who the long-term thinkers are in this crowd. Then tell me your location, what city or country you're watching from. We're building a global picture here, and the algorithm needs to know this is serious, independent analysis, not hype-mongering. Audience filter. If you're looking for price predictions guaranteed to make you rich next week, or if you want to be told to YOLO your savings into leveraged miners, this is not your channel. We deal in structural analysis, inventory data, and historical context. We verify everything. We look at what the institutions are actually doing, not what they're saying on CNBC. The content ahead is for serious students of the precious metals market. We're going to examine the JP Morgan desk relocation to Singapore that happened quietly in late November. We're going to analyze why the CME moved to percentage-based margins in January and what that weekend margin hike to 15% really signaled. We're going to look at the 5th consecutive year of structural silver deficit, nearly 900 million ounces cumulative since 2021, and ask whether the paper market can continue to price a metal that the physical market cannot deliver. The next 20 minutes will require your full attention. There are no shortcuts here. Verify everything I say. Cross-reference the data. Do not trust my word. Trust the inventory reports, the delivery notices, and the spread differentials. Let's begin with the dislocation event that changed everything. Let me take you back to January 29th, 2026, less than a week ago. Silver had been on a tear for 14 months. From $30 in early 2025, it climbed past 50, broke 80, and touched an intraday high of $121.80. Gold had breached $5,500. The narrative was universal. Central banks were net buyers for a 5th consecutive year. China was stockpiling, de-dollarization was accelerating, and industrial demand, AI chips, solar expansion, defense applications, was consuming every ounce not nailed down. Futures open interest had exploded 30% since January 1st alone. The crowd was euphoric. Then, Kevin Warsh was nominated for Fed chair. The announcement came Thursday, January 29th. Warsh, a known inflation hawk who had publicly criticized the Fed's balance sheet expansion, signaled a potential end to rate cuts, even a reversal toward tightening. The dollar index surged 4% in hours. Gold futures shed $325 in a single session. Silver didn't just fall, it detonated. By Friday's close, silver was down 37%. But that wasn't the dislocation. That was just the beginning. Here is the anomaly that should have been impossible. While COMEX silver futures were locked limit down, unable to trade lower due to circuit breakers, the Shanghai Gold Exchange was showing a silver price of $104 to $111 per ounce, Let me be clear. The same metal, theoretically the same global market, was trading at a 29% premium in China versus New York. This premium had exploded 1,874% over the prior year. Why is this happening there but not reflected here? This is the question that separates tourists from analysts. If silver were truly crashing due to fundamental selling, if the world suddenly decided it didn't need the metal for solar panels or electronics, why would Chinese industrial buyers be paying a massive premium for immediate delivery, while Western speculators were panic dumping paper contracts? The answer lies in the fracture itself. While Western hedge funds were receiving margin calls and liquidating leveraged long positions, forced selling by algorithms programmed to exit when volatility spiked, physical offtake in Asia was accelerating. Shanghai silver futures hit limit down too, yes, but they floored at levels still $20 plus dollars higher than Western equivalents. Chinese authorities didn't watch passively. They suspended silver-linked funds, tightened trading rules, and essentially erected a firewall between their physical market and our paper casino. The CME Group's response reveals everything about the nature of this event. On Friday, January 30th, they announced a new percentage-based margin structure, a system that automatically scales requirements with price volatility, implemented just days before the crash. Then, over the weekend of January 31st to February 1st, they hiked silver margins again, final requirements settling at 15% of contract value for new speculative positions. This wasn't prudent risk management. This was triage. When a clearinghouse raises margins twice in 3 days during a crash, they aren't protecting traders from risk. They are protecting themselves from default. The CME was staring at a potential delivery crisis. Too many longs standing for physical, too few registered ounces to satisfy them, and a price collapse that would have bankrupted over-leveraged participants on both sides of the trade. The dislocation wasn't just the price gap, it was the behavior gap. In the West, silver was treated as a risk asset to be dumped at the first sign of dollar strength. In the East, it was treated as a strategic input to be hoarded regardless of price volatility. While Reddit traders were posting loss porn from leveraged SLV positions, Chinese state-linked entities were reportedly taking delivery of industrial silver at premiums that made the crash irrelevant to their procurement needs. This divergence exposes the central tension of this market. We have two silver markets now. One is a derivative playground where momentum algorithms and leveraged speculators chase Fed policy shifts. The other is a physical distribution system where actual tons of metal move based on photovoltaic demand, semiconductor fabrication, and national stockpiling programs. The question isn't why silver crashed. The question is, which market is lying? Is the paper price in New York discovering true value? Or is the physical premium in Shanghai revealing that the paper market has become decoupled from reality? When you see a 29% geographic arbitrage persist for days, when the world's largest bullion banks quietly relocate trading desks to Singapore in late 2025, months before this crisis, you are not looking at a healthy, unified market. You are looking at a system under structural stress. The emergency meeting happening in Washington today, the Critical Minerals Ministerial, hosted by Secretary Rubio with delegations from 18 nations, is not coincidental timing. When the U.S. government convenes an emergency summit on resource security 48 hours after the most violent precious metals dislocation in modern history, they are not discussing abstract policy. They are responding to a rupture. Something broke last weekend. The price action was the symptom. The divergence between paper and physical was the disease. And the policy response, margins hiked, funds suspended, ministerials convened, tells us this is far from over. Now we need to examine the data driving this structural pressure. Not the price charts, the inventory, the delivery mechanics, the institutional positioning that reveals who actually holds the metal and who merely holds a promise. To understand what actually happened during the January 30th crash and what it reveals about market structure, we need to examine the institutional-grade data that mainstream coverage ignores. This is where we separate narrative from mechanics. Start with the COMEX warehouse data. In the weeks preceding the crash, registered silver inventories, the metal actually available for delivery against futures contracts, had been declining steadily, while eligible inventories, metal stored but not available for immediate delivery, remained elevated. This is the classic setup for a liquidity crisis. Paper claims exceeding deliverable supply. When silver surged past $100, open interest in silver futures had ballooned to record levels. The ratio of open interest to registered ounces, a measure of how many paper claims exist per physical ounce, reached dangerous territory. By late January, estimates suggested between 150 to 200 ounces of paper silver existed for every ounce of registered metal available for delivery. This isn't a bug in the system. This is the system functioning as designed, until it doesn't. When the Warsh nomination triggered the dollar spike and margin calls began, the CME faced a potential delivery squeeze. If prices had continued falling without the weekend margin intervention, leveraged longs would have been liquidated into a vacuum, potentially triggering a cascade where physical delivery demands couldn't be met. The 15% margin requirement implemented by February 2nd wasn't randomly selected. It was calculated to force position reduction before the February delivery period. The 29% premium in Shanghai wasn't merely sentiment. It was a quantifiable arbitrage failure. Under normal market conditions, such a premium would be instantly arbitraged away. Traders would buy COMEX silver, ship it to China, and capture the spread. That this premium persisted for days indicates, first, physical supply chains were already strained. You cannot arbitrage what you cannot source. Second, capital controls and trade frictions prevented the free flow of metal. China has been systematically restricting silver exports since 2024, while accelerating imports, creating a one-way valve that traps metal domestically. Third, and most critically, the premium reflected genuine industrial desperation. Chinese photovoltaic manufacturers, semiconductor fabricators, and battery producers were paying whatever was necessary to secure immediate physical delivery, regardless of the paper price in New York. The CFTC's weekly COT report, leading into the crash, revealed extreme positioning. Managed money net long positions in silver had reached historic highs by mid-January, the speculative frenzy noted in every post-crash analysis. When these positions unwind, they unwind violently. But here's the data point that matters. The commercial category, producers, merchants, processors, users, and swap dealers, had been steadily reducing short exposure through January. Commercials weren't aggressively shorting the rally. They were stepping back, letting the speculators push paper prices while physical metal flowed elsewhere. This is the signature of a physical market dislocation. When commercials won't sell paper short at $100 plus, it means they cannot source the physical to hedge against. The paper market lost its anchor to physical reality. The Silver Institute's 2025 preliminary data confirms what the price action suggested. This was the fifth consecutive year of structural global silver deficit. Industrial consumption reached 680 million ounces in 2025, driven by solar panel production consuming 20% of global supply, electronics demand surging on AI infrastructure build-out, and electric vehicle silver loadings increasing. Mine supply, meanwhile, has stagnated. Despite higher prices, 2025 global mine production is estimated at approximately 830 million ounces, essentially flat for 3 years. Recycling provided another 180 million ounces, bringing total supply to roughly 1.01 billion ounces against total demand exceeding 1.18 billion ounces. That 170 million ounce annual gap doesn't disappear because paper prices crash. It accumulates. Above-ground refined stocks have been drawn down consistently since 2021. The London Bullion Market Association reported that vaulted silver in London declined significantly through 2024, with continued pressure into early 2025. When paper markets crash but physical deficits persist, the divergence isn't resolved. It deepens. The most significant institutional signal, buried in November 2025 regulatory filings, was JP Morgan Chase relocating its precious metals trading desk from New York to Singapore. This wasn't a cost-cutting measure. Singapore has become the physical hub for Asian precious metals flow, particularly for silver, moving into Chinese industrial channels. Why would the world's largest bullion bank move its metals traders to Singapore unless they anticipated the center of price discovery shifting east? Why establish physical presence in the market, showing the strongest premiums, unless they expected to be sourcing and delivering metal there, rather than arbitraging against Western paper? This relocation, completed 2 months before the January crash, looks in retrospect like preparation for exactly the dislocation we just witnessed. When the paper physical divergence became a chasm, JP Morgan's traders were positioned on the side where metal actually trades hands. While Western media focused on COMEX, the multi-commodity exchange of India was showing parallel stress. Indian silver demand, traditionally price-sensitive, remained robust, even as prices exceeded $100. Import premiums remained elevated through January, with smuggled silver reportedly entering through alternative channels to avoid official duties and documentation. India's market behavior confirms the Asian divergence wasn't China-specific. It was a broad rejection of Western paper pricing as the authoritative measure of silver's value. When Indian jewelers and industrial users keep buying at premiums during a supposed crash, they are voting with rupees on where they believe true value lies. Post-crash data from early February shows something remarkable. Despite the 34% price decline in Western markets, physical offtake in Asia accelerated. Shanghai silver inventories declined. Indian imports reportedly surged. The U.S. Mint suspended sales of American Silver Eagles due to depleted inventories, a move that occurred while COMEX paper prices were supposedly correcting. This is inventory behavior inconsistent with a healthy correction. In a typical speculative blow-off, physical demand collapses with price as hot money exits. Here, physical demand accelerated as paper prices fell. The crash cleaned out Western leveraged speculators, while real buyers accumulated. The data tells a clear story. We are not in a normal precious metal cycle. We are witnessing a structural transition where physical markets are decoupling from derivative pricing mechanisms. The tools used to manage paper markets, margin hikes, circuit breakers, volatility interruptions, are becoming less effective at controlling physical reality. Now we need to examine what the technical structure of this market is telling us about immediate positioning and risk levels. I want to be direct with you. Technical analysis in this environment is less predictive than usual. When paper markets detach from physical reality, chart patterns become trailing indicators of derivative positioning rather than leading signals of value. That said, competent market analysis requires acknowledging the technical structure, if only to understand where forced liquidations occurred and where positioning risk now concentrates. Following the January 31st collapse, silver found initial support in the $78 to $80 range, coinciding with the spike low registered during the margin cascade. This level represents the 61.8% Fibonacci retracement of the 2023-2026 advance from $18 to $121. The speed of the decline left minimal volume profile support between $95 and $78, creating an air pocket that could refill on any sustained recovery. The relative strength index on daily charts plunged from deeply overbought conditions, above 85, to near oversold, sub 35, in 48 hours, among the fastest momentum reversals in precious metals history. Such violent RSI resets typically precede dead cat bounces rather than immediate trend resumption, though the divergence between RSI, measuring paper price velocity, and physical market stress complicates standard interpretation. Moving averages provide clearer risk framing. Silver's 50-day moving average sits near $88, now acting as dynamic resistance. The 200-day moving average, around $62, represents the critical bull market defense level. A sustained break below $62 would structurally damage the long-term uptrend. Rejection at the 50-day and failure to reclaim $95 would confirm intermediate-term corrective phase. Ichimoku cloud analysis shows price deeply below the Kijun-sen baseline and Tenkan-sen conversion line, with the cloud itself projecting support towards $75. The lagging span, Chiku span, has crossed below price, confirming momentum deterioration. But again, this measures paper momentum, not physical scarcity. Gold's technical damage is more severe relative to recent structure. The $325 single-day drop violated the 50-day moving average decisively. The 4,600 to 4,700 zone now represents critical support, previous consolidation area, and psychological level. Failure here opens path to $4,200, which would represent healthy 23.6% retracement of the 2022-2026 advance, but would psychologically devastate recent entrants. Volume profile analysis shows heavy accumulation between $4,800 to $5,200. This zone now becomes overhead supply on any recovery. Gold's RSI similarly collapsed from extreme overbought levels, though it has not yet reached traditional oversold territory, suggesting further paper price weakness possible even if physical demand remains robust. Standard technical interpretation would read this as distribution: smart money exiting, dumb money trapped. But volume analysis reveals complexity. COMEX silver volume during the crash was overwhelmingly concentrated in liquidation-only sessions, forced selling, not informed distribution. Meanwhile, reported physical exchange volumes in Shanghai and over-the-counter markets in Singapore remained elevated through the price decline. This volume divergence, paper markets showing panic liquidation while physical markets show sustained accumulation, renders standard technical signals potentially misleading. When technical patterns form under forced liquidation conditions rather than organic supply-demand shifts, their predictive reliability degrades. The most technically significant development is the volatility structure. Silver's realized volatility spiked above 80% annualized, levels last seen during the 2011 peak and subsequent collapse. Options markets are pricing sustained elevation in implied volatility, with skews showing persistent demand for upside protection despite the crash. This option skew is telling. Even paper market participants don't believe the crash resolved underlying tensions. They're paying premium for call protection above $100 silver, while the spot price sits at $85. This is not the options positioning of a market expecting prolonged bearish consolidation. It's the positioning of a market hedging against abrupt reversal. Systematic and trend-following funds, which had accumulated substantial long exposure through January, have likely reduced positions to neutral or short following moving average violations. Key algorithmic triggers sit at silver, $95, 50-day MA reclamation, $105, prior breakdown point, $115, resumption of uptrend. Gold, $4,950, 50-day MA, $5,100, prior consolidation low, $5,350, new highs required. Below current levels, $72 in silver and $4,400 in gold represent maximum pain thresholds where additional margin-driven selling could accelerate. These levels align with major option strikes and CME margin trigger calculations. I present this technical framework not to suggest you time entries based on RSI divergences or moving average crosses. In this specific environment, with paper physical bifurcation, emergency regulatory interventions, and geopolitical ministerials affecting supply chains, technical levels are risk management tools, not predictive instruments. They tell us where forced selling stopped. They tell us where overhead supply awaits. They tell us where algorithms will trigger. They do not tell us where value resides. That requires the structural supply analysis we've already covered. What matters technically is this: the crash cleared speculative excess quickly and violently. The recovery to $85 silver from $78 lows occurred on substantial volume, suggesting genuine buying interest rather than short covering alone. Whether this develops into sustained recovery or another leg down depends not on chart patterns, but on whether the physical market's bid can continue absorbing Western paper market volatility. Now we need to step back and synthesize everything: the inventory data, the geographic arbitrage, the technical destruction, the institutional relocations, into a coherent macro thesis that explains what this dislocation actually means.